China has 250% more electricity than America, and that gap could decide the global AI war.
Macro expert Clem Chambers explains this energy crisis alongside crucial warnings from 3 other top financial veterans.
Discover why Bitcoin is tracking BlackRock into a liquidity trap and which specific sector faces a 45% crash. We are joined by Clem Chambers, who has made a series of impressive calls over the last year.
Right. He correctly predicted the downside for Bitcoin and even anticipated the market top before it happened.
He also notably called the start of the Iran conflict, just a day before it began.
His track record is why many are paying close attention to his current forecast for Bitcoin, gold, and the broader economy. Clem's central thesis right now is that electricity is destiny. He believes the future of the West depends entirely on the AI race.
And he's worried because China currently has 250% more electricity than America.
So, if the US doesn't win the AI war, the current democratic system could be at risk.
That is his warning. He says there is no second place in AI, and it all comes down to energy production. Clem argues that the original Satoshi dream for Bitcoin is under threat because it has moved from being B2C to B2B.
He literally calls the new institutional players looters who are just looking to suck out liquidity.
He also mentions a dark side to the crypto space involving online scamming operations in Asia, laundering money through Bitcoin.
Exactly. And he believes these factors are creating significant headwinds for the asset.
Clem views gold primarily as an asset for war, specifically tied to the potential conflict over Taiwan.
He thinks the current pullback in gold is because that conflict has been postponed or at least calmed down for now.
So if we see gold start to run like a rocket again, it is a bad sign for global peace.
Precisely. He says gold will only go vertical if a major conflict is imminent. The discussion touches on the polite decline of Europe compared to the United States.
They cited Jamie Dimon's observation that Europe's GDP has dropped from 90% of the US level down to 70%.
What is driving that? High taxes and anti-business debt structures.
That is what they suggest. Clem agrees that the European supertanker is very hard to turn around.
For the crypto fans, Clem is not expecting a moonshot right now. He expects a retrace.
He is looking for Bitcoin to settle somewhere between $30,000 and $40,000.
And he mentioned it could even dip under 30,000 in a worst-case scenario.
He thinks that 40,000 is the most likely level where it will start to go sideways.
As for gold, Clem is looking for it to settle around $3,500.
Is he selling at that level?
Actually, he says that is where he will start itching to buy. He plans to dollar cost average into gold once it hits that 3,500 target. Clem's final advice is to recognize we are in a K-shaped economy.
He says no one is going to invite you to be on the winning leg. You have to get there yourself by being active in the markets.
And stay optimistic about America's ability to innovate.
Yes. He remains a bull on the US long term, provided they win the AI race and keep manufacturing moving. Bitcoin just broke down again, dropping below 60,000, but the real story isn't just the price drop, it's how it's tracking BlackRock.
Exactly. Jeff Snider points out that this isn't a random coincidence. It looks like a shared warning signal from 2 very different asset classes.
So, if the world's largest asset manager and the biggest cryptocurrency are moving together to the downside, what is the market actually telling us?
Snider argues they are both responding to a global liquidity shift that most people are overlooking.
The core thesis here is that Bitcoin and BlackRock are acting as indicators for a system-wide liquidity drain.
Right. It's not about one asset crashing. It's about offshore institutions and households pulling money out of the system because they need dollars.
Is this just a US issue, or is it bigger than that?
It's global. Snider connects this to everything from private credit stress to the movement of the Hang Seng index in Hong Kong.
Snider highlights that large offshore institutions are hit by redemption requests and are pulling money out of private credit funds.
And, interestingly, it's not the American investors leaving, it's the offshore players who are most sensitive to the dollar credit cycle.
Why are they pulling out now if these funds offer high returns?
Because they suspect the future net asset value will be much lower and they want to get their money out while they can still get the full value today.
With savings rates at rock bottom levels, households are increasingly forced to sell assets like Bitcoin and gold just to pay their bills.
It's a sign of a slowing economy. When people are behind on their mortgage or food costs, they sell what's easy to liquidate, and Bitcoin is right at the top of that list. Snider uses the Hong Kong Hang Seng index as a dependable eurodollar signal for the global economy.
When the index rallies, it shows reflationary money flowing into China. When it drops, like it has since last October, it's a sign that liquidity is drying up globally. Snider predicts that we'll see more funds gate their redemptions, essentially telling investors they can't have their money back.
We've already seen this with Apollo. As inflows slow down and outflows increase, these funds will have to draw on cash reserves or borrow, ruining their performance further.
A seizing up of the credit market will likely lead to widespread layoffs as small businesses lose access to the capital needed to grease their supply chains.
When the credit dries up, inventory doesn't move, and businesses can't make payroll. That is when the whole cycle comes crumbling down. The main takeaway is to stop listening to the mainstream strong and resilient narrative and start watching the actual market signals.
Look at the 9 months of decline in Bitcoin, BlackRock, and the Hang Seng. The air is slowly coming out of the system.
So, don't just react to the news. Learn to read the plumbing of the global dollar system.
The hidden leverage in offshore subsidiaries is a huge problem. It's similar to 2008, even if the specific assets are different this time. Craig is monitoring the markets on this Monday, June 29th, and while we are seeing a bounce today, he is noting some underlying weakness.
That is right. He mentions that the 30-minute momentum chart is turning orange, which is a neutral sign, after being in an oversold green state.
So the market is trying to decide if this is just a pause before going higher, or a potential double top.
Exactly. He is seeing bargain hunters step in, but the Magnificent 7 tech stocks are continuing to break down.
Craig's main thesis is that we are seeing a significant rotation of capital right now.
Money is moving out of the big tech companies that look overvalued and into small caps via the Russell 2000, which is up about 1/3%.
And he also mentioned defensive plays like utilities and real estate starting to rally.
Yes, he specifically highlighted that big money is moving into boring utilities, like the XLU, as the broader stock market starts to struggle.
The biggest warning in this update is about SPCX, which Craig also refers to as SpaceX.
It is trading at a critical support level. He warns that if it breaks down, there is a precipitous 45% downside move ahead.
That would be a massive decline. How would that affect the rest of the market?
He believes it would completely kill the appetite for other upcoming IPOs, as investors could lose more than half of their money.
In the bond market, we have seen a rally up to a 100% measured move, which aligns with the 150-day moving average.
Craig notes this is a significant resistance area. If bonds reverse here, it could bring inflation fears back into the energy market.
What is the outlook for gold and silver today?
Both are struggling. Gold is down 0.9% and trying to find its footing, while silver is down 1.3% in what looks like a bearish pattern.
Bitcoin is also in a clear downtrend, showing a tiny pause but likely to continue sliding lower. Despite the current downtrend in energy, Craig expects a relief rally for oil.
He is targeting a bounce back up to the $80 mark, and potentially even as deep as $87 or $90. Craig predicts that if the support for SPCX fails, it will lead to a major unwinding event.
Meaning people who bought in during the peak surge could see a 60% decline?
Exactly. He thinks that kind of damage would sour the market for any big IPOs coming out in the near future. The tactical takeaway here is to keep a close eye on that SPCX support level for a breakdown signal.
Craig also stresses the importance of diversification. You want sectors like utilities to move at different times than your index plays to protect your portfolio.
So it is about hitting base hits and waiting for the long-term plays to mature.
Precisely. Stay with the trend and do not try to pick a top in this environment. We are looking at Matt deWolf's latest breakdown, and he's basically saying the market just pulled a massive bait and switch after the Micron earnings.
Yeah, everyone thought those numbers were going to be the rocket fuel we needed. But instead, we got what he calls a gap and crap. A huge open that immediately got sold off.
Wait, so the good news actually made things worse? How does that even work?
It's about expectations versus reality. The market opened at the highs, hit a wall of sellers, and spent the rest of the day sliding.
Matt's core argument is that Micron didn't save the market. It actually provided the exit liquidity for big players to dump their positions.
Exactly. When you see an inverted hammer candle on the daily chart after a gap like that, it's a textbook sign that the bulls have run out of steam.
So all that morning excitement was just a trap for people buying the open.
That's exactly how Matt frames it. It wasn't just Micron. The entire S&P 500 and the Nasdaq followed that same ugly pattern.
Matt pointed specifically to $110 on Micron. It gapped way above it, but it couldn't stay there for more than a few minutes.
Is 110 that important? It's just a number, right?
In technical terms, it was a massive psychological and structural level. To see it trade all the way back down to the bottom of the daily range is incredibly bearish.
He also noted the SPY was struggling at that 530 mark. It tried to break out and just got slammed back down.
And the volume was there to back it up. This wasn't a low-volume drift. People were actively hitting the sell button as soon as we touched those highs.
If you look at the Nasdaq, or the triple Qs, Matt highlighted that shooting star or inverted hammer candle.
And what does a shooting star actually tell us though?
It tells you that buyers tried to push the price up, but sellers completely overwhelmed them by the end of the session. It's a sign of exhaustion.
Looking ahead, Matt is calling for a gap fill. He thinks Micron could head all the way back down to $96 or $97.
Wait, so it could lose all the gains from the earnings report?
That's the risk. When a gap fails that quickly, the price often gets sucked back down to where the move started.
For the broader market, he's staying neutral to bearish until the SPY can actually close above 530.
Right. Until we see those highs taken out, the path of least resistance is officially down.
The main takeaway here is to watch the lows from today's session. If we break below them tomorrow, the trap is fully sprung.
So if it starts red tomorrow morning, I should probably be worried?
Exactly. Matt's watching for follow-through. If there's no bounce, we're likely looking at a deeper correction.
He's basically saying, don't be a hero and try to buy this dip just yet.
Wait for the market to prove it has found a floor. Right now, it's still falling from that $110 rejection.
Let's start fast with Matt deWolf. His short, sharp take was that Micron pulled a classic gap and crap after earnings.
Right. He flagged the $110 level as the bait. Then sellers showed up so hard, the stock couldn't hold the open.
So he thinks the whole move was basically exit liquidity for big players. Ouch.
Exactly. Matt is neutral to bearish for the market until the SPY can actually close above 530. Otherwise, watch the gap fill down toward the mid-90s on Micron.
Craig Hemke's angle is more sectoral. He's seeing a rotation out of big tech and into boring defensive plays.
He points to flows into utilities and the Russell 2000 showing some life, while warning that SPCX sits on critical support.
And if SPCX breaks, he said what, a 45% plunge? That's brutal.
Yes. Craig thinks that would kill IPO appetite and force a major unwind, so tactically he's urging diversification into sectors like utilities.
Jeff Snider brought the macro plumbing. His headline, Bitcoin and BlackRock are both telling us the same scary story.
He noted Bitcoin has broken below 60,000 and that BlackRock flows are moving in a way that looks like a global liquidity drain from offshore players.
So this isn't just price action, it's institutions and redemptions pulling cash out of the system.
Exactly. Jeff warns of gated redemptions, private credit stress, and that these dollar funding strains can cascade into real economic pain.
Finally, Clem Chambers zooms way out. His thesis is structural. Electricity is destiny in the AI race.
He points to China having 250% more electricity capacity than the US, and says that gap could decide who wins AI and who doesn't.
And he also gives explicit price levels. Bitcoin settling between 30,000 and 40,000, with the risk of dipping under 30,000, and gold around 3,500.
Right. Clem is expecting a retrace for crypto and is preparing to cost average into gold when it hits that 3,500 level.
What ties these takes together is surprisingly simple. All four guests see real market stress beneath the headlines.
Matt reads it as failed breakout liquidity. Craig sees capitulation into defensives. Jeff points to a global liquidity drain, and Clem flags institutional extraction. Different language, same symptom.
So whether it's sellers at an earnings open or offshore redemptions, the market's internal engine is sputtering.
Exactly. They agree the surface bounce is fragile because the underlying flows and structure are strained.
On crypto, three of our guests converge. Clem, Jeff, and Craig all call Bitcoin weak and trending down.
Jeff emphasized the breakdown below 60,000 and its role as a liquidity indicator. Craig labeled Bitcoin a clear downtrend, and Clem expects it to settle between 30,000 and 40,000.
Hold on. That's a big gap between 60,000 and 30,000. Are they all really on the same page?
They are aligned on direction, lower, even if Clem gives a longer-term settling range, while Jeff focuses on the ongoing sell pressure and institutional flows.
A tighter pairing. Clem and Jeff both single out institutions as active agents of liquidity removal.
Clem calls the new institutional entrants looters siphoning liquidity, while Jeff describes offshore redemptions and gated funds as the mechanical way liquidity disappears.
So both think it's not retail panic alone, it's the big players quietly taking money off the table.
Yes. Their shared reasoning is that institutional behaviors, redemptions, balance sheet moves, or looting create lasting market strain beyond single events.
Now the real tension. Everyone sees trouble, but they disagree about the root cause. Let's unpack that.
Matt frames it as event-driven technical failure. The Micron gap above $110 was a selling magnet, and the SPY failed at 530. That's pure price structure exhaustion.
Wait, so Matt says it's mostly the tape and traders hitting exits around specific levels?
Exactly. But Jeff pushes back. He says it's not just the tape, it's a global liquidity drain. Bitcoin under 60,000 and BlackRock flows are symptoms of offshore redemptions and baited funds.
So Jeff thinks this is a systemic funding problem, not just intraday sellers. That's a much scarier diagnosis.
And Clem adds a different dimension. He argues the real long-term battleground is energy and AI, pointing out China has 250% more electricity. So structural competitiveness, not just liquidity or tape, will reshape markets.
Craig sits somewhere between those views. He sees rotation and sector-level mechanics, SPCX support, defensive inflows, and a potential 45% SPCX shock, which is a tactical, risk event view rather than a pure macro diagnosis.
So, who should I listen to? Are we trading technical levels, preparing for gated redemptions, or reallocating around energy winners?
All of them have valid reasoning. Matt's right on near-term price behavior. Jeff flags system risk that can amplify moves. Clem stresses structural winners and losers. And Craig gives the tactical sector playbook. The clash is really about timescale and mechanism. Trade the tape, hedge liquidity risk, and keep an eye on structural energy gaps.
If this comparison helped you cut through the noise, hit like and subscribe so you catch our next expert roundup.
We bring together opposing takes so you can see the risks, the levels, and the opportunities without piecing it together yourself.
Seriously, this saved me hours. I'm sharing it with friends who trade and those who just want to protect savings.
Thanks for watching. Stay curious, stay cautious, and we'll see you in the next video.